What if I told you that doing the smart thing with your money could quietly trap you for decades? Because that's exactly what happened to me. I did everything right. Automatic investing, long-term mindset, low-cost ETFs, and I put almost all my money into VOO. On paper, it was perfect. Historically, the S&P 500 has averaged around 10% a year over long periods. Compound that long enough and you're supposed to be set. But then reality hit. When markets dropped, my account dropped with it. And nothing came back to me. No real cash flow, no flexibility. Just the hope that one day, far in the future, it would all be worth it. Disclaimer: this video is for educational purposes only and is not financial advice. Investing involves risk, including loss of principal. Yields and distributions can change, and past performance does not guarantee future results. And here's the part that really messed with my head. I ran the numbers. If you invest consistently for 30 or 40 years at market level returns, most of the money you end up with doesn't come from what you put in. It comes from compounding. That sounds powerful, but it also means one thing. You're completely dependent on time. Miss a decade, need income early, or hit a rough market cycle at the wrong moment. And suddenly that safe plan starts to feel like a slow-moving financial treadmill. That's when I ask myself a question most investors never stop to ask. Is the goal really just to grow a big number? Or is it to create options? Because growth without income delays freedom, and income without growth caps your future. What I discovered is that you don't actually have to choose between the two. There's a simple 2 ETF setup that, based on real historical data, would have delivered comparable and in some periods higher total returns than VOO, while also building meaningful income along the way. No stock picking, no leverage, no shortcuts. In this video, I'm going to break down exactly how that works. The 2 ETFs, why they complement each other, the long-term data behind them, and how I personally use this framework to avoid the VOO-only trap. This isn't about getting rich quick. It's about not waking up 20 years from now, realizing you optimized for growth, but forgot about freedom. The hidden problem with VOO nobody talks about. Here's the part nobody warns you about when they tell you to just buy VOO and chill. Yes, a VOO, the Vanguard S&P 500 ETF, is one of the most trusted investments in the world. It's low cost, fully diversified, and backed by over a century of market data. Over the past 10 years, VOO has delivered a solid 14.5% average annual return, which is outstanding. But if you zoom out and take the longer-term average, it's closer to 10 to 10.5% annually, including dividends. That's still strong. But here's the catch. VOO only yields around 1.3% in dividends right now. So if you're investing $100,000, that's about $1,300 a year. Before taxes. That's not life-changing income. And that's the real trade-off. You're getting growth, but you're delaying freedom. The strategy works best if you can wait 30 or 40 years without needing income from your investments. But what if your timeline is different? What if you want flexibility sooner, in 10, 15, or 20 years? What if you want the option to work less, relocate, or cover your basic bills from portfolio income? This is the myth of the VOO-only path. It gives you growth, but no cash flow. It's like building a mansion with no doors. You might end up with $1 million net worth, but still feel stuck, because you can't access it without selling shares. And in a down market, selling means locking in losses. So even if you win, you're still waiting, still stuck, still hoping the number keeps growing. And that's what pushed me to redesign my entire investment approach. In 2022, I made a shift. I wanted to stay passive. I didn't want to pick stocks, time the market, or play games with options. But I also didn't want to spend the next 20 years hoping my growth plan would eventually turn into freedom. That's when I created what I now call the 2-leg wealth framework. It's simple, it's all ETF-based, and it completely changed how I think about investing. Leg 1 is income. I wanted part of my portfolio to pay me regularly, even during down years. That meant dividend-focused ETFs. Ones with real track records, real companies, and consistent quarterly payouts. This leg is all about stability, cash flow, and emotional resilience. Because when you're getting paid, even a little, you're more likely to stick with your plan. Leg 2 is growth. I didn't want to miss out on long-term upside, especially in tech, innovation, and large-cap US companies that have historically driven market gains. So I needed a growth-focused ETF with long-term outperformance, low costs, and diversification across top growth names. This leg is all about acceleration, wealth building, and long-term compounding. The beauty of this system is that the two legs do different jobs. One gives you income you can use, the other gives you capital gains you can grow. Together, they balance each other out emotionally and mathematically. You're not just investing to grow a number. You're building a financial engine that creates options, real freedom options, along the way. And I'll show you exactly which ETFs I use in each leg, how they've performed, and how you can set it up, even if you're starting with just a couple $100 a month. ETF number 1, the Quiet Paycheck Machine, VYM. Let's start with the first leg of this framework, the one that gives you income and emotional stability when everything else feels like chaos. I call it the Quiet Paycheck Machine, and it's powered by an ETF called VYM, Vanguard High Dividend Yield ETF. Now, VYM is not flashy. You're not going to see it trending on social media, but this fund has quietly done exactly what it's built to do: deliver consistent income and steady long-term returns. It tracks the FTSE High Dividend Yield Index, which is basically a curated list of large U.S. companies with above-average dividend payouts. We're talking about dividend veterans like Johnson & Johnson, J.P. Morgan Chase, Procter & Gamble, Home Depot, and dozens more in sectors like financials, healthcare, and consumer staples. Over the past 10 years, VYM has delivered an average annual total return of around 11.5%, with a dividend yield that usually ranges between 2.5% and 3.5%, depending on market conditions. That's almost triple the yield of VOO. And it's not just a number on a screen. It's real cash hitting your account every quarter. Now here's where it really earned my trust: 2022. The market was down big. VUG, which I'll talk about in a second, got crushed. VOO dropped around 18%, but VYM, it held up with barely a scratch, down just about 0.5% by year-end, and it still paid its dividends on schedule. While everything else felt like it was on fire, VYM felt like a calm, steady hand. That's the emotional payoff of this leg. Even in ugly markets, you're still getting paid. And that income starts to feel more and more meaningful as your portfolio grows. For me, this was the first time I felt like my money was actually working for me. Not just waiting to grow someday, but doing something right now. ETF number 2, the growth rocket with a real liftoff, VUG. Now let's talk about the second leg, the growth engine. The part of the portfolio that's built to chase upside and multiply wealth over time. This is where VUG comes in, Vanguard Growth ETF. VUG tracks the CRSP US Large Cap Growth Index, which is just a fancy way of saying, give me the biggest, most dominant US companies with high growth potential. And it delivers. Its top holdings are a who's who of tech and innovation: Apple, Microsoft, Amazon, Nvidia, Tesla. Companies that don't just grow, they scale globally. Over the last 10 years, VUZ has returned around 17 to 17.5% annually, significantly outpacing both VOO and QQQ during this stretch. And unlike QQQ, which charges a 0.2% expense ratio, VUG comes in at just 0.04%, one of the cheapest growth funds out there. That difference may seem small, but over decades, it adds up. And compared to other popular but expensive growth funds like ARKK, which charges 0.75%, VUG is almost 20 times cheaper. Now, don't get me wrong, VUG is not a smooth ride. In 2022, it dropped by more than 33%. It got punched in the face. But here's the thing. It came roaring back in 2023 and 2024 as tech rebounded and growth regained momentum. That's the nature of this side of the portfolio. High volatility, but also high potential. The key is this. When you combine it with something like VYM, you don't have to panic when growth is down. You already have a leg in dividends. So you let this leg do its job, ride the volatility, and let time do the heavy lifting. That's what gives you peace of mind, because you're not betting everything on a single style. You're not hoping the market behaves. You've got a system that absorbs shocks, takes advantage of rebounds, and keeps moving forward, even when things get bumpy. If this shifted how you think about investing, even just a bit, hit the like button. It tells me you value real research over recycled advice. And if you want more deep dives like this, subscribing is the easiest way to stay ahead while others chase hype. No fluff, no noise. Just clear, data-backed content that helps you build real freedom over time. The big test. Would this combo have beaten VOO? Let's put all the theory to the test. We've got VYM, the steady dividend generator. We've got VUG, the high growth rocket. But does combining them actually beat just investing in VOO? Here's what I found when I ran the numbers. Over the past 10 years, VOO delivered around 14.5% average annual return, including dividends. VYM came in at about 11.5% annually, a bit lower but with a much higher yield. VUG, on the other hand, posted 17.3 to 17.5% per year, significantly higher than both. Now imagine a simple portfolio, 70% in VUG, 30% in VYM. The same mix I personally used in my 30s. Blended together, this combo would have returned about 15.5% per year. Historically, slightly higher than VOO with the added bonus of more income and a smoother ride during certain downturns. But let's make it real. What if you invested $500 a month into these strategies for the last 10 years? With 100% in VOO, you'd end up with roughly $133,000, assuming a 14.5% CAGR. With 70% in VUG and 30% in VYM, you'd have closer to $143,000 at a 15.5% CAGR. That's a $10,000 difference on the exact same contributions, without touching a single stock or lifting a finger, just by choosing a different mix of 2 index ETFs. And that's not even factoring in the dividend income you'd be collecting from VYM along the way. Even reinvested, that income adds flexibility. You could have used it for rebalancing, extra shares, or just letting it sit as dry powder. This isn't a promise, it's just what the data shows if the future rhymes with the past. But what it proves is simple. The way you allocate your money matters just as much as how much you invest. Apply it, the weekly wealth engine. Let's talk execution, because ideas are useless without action. Here's how to turn this 2 ETF strategy into something real. Even if you're starting small, let's say you can invest $100 a week or $500 a month. Using the same 70-30 split, you'd put $350 per month into VUG and $150 per month into VYM. Most brokers today, Fidelity, Vanguard, Schwab, M1 Finance, let you automate these transfers and even fractional ETF purchases. So you don't need thousands of dollars to get started. You just need to set it and forget it, and let the system work for you. Now, depending on where you are in life, here's how I personally think about adjusting the mix. If you're 25 to 35, you've got time on your side. I'd lean more into growth, maybe even 80% VUG, VYM. You can afford the volatility and you'll benefit the most from long-term compounding. If you're 35 to 45, this is where life gets busier, more expensive, and more uncertain. I'd aim for balance, something like 70% VUG, 30% VYM, or even a 60-40 if you prefer more stability and income. If you're 45 and up, now you start shifting toward income and risk management. A 50-50 split becomes very reasonable here, especially if you want to start using those dividends in the next 5 to 10 years. The beauty of this system is that you can start small, scale over time, and adjust the mix as your life changes, not as the market does. And that's the key. You're not reacting to headlines or trying to beat the market in a single year. You're building a weekly wealth engine, one that grows, pays, and adapts with you. Build your freedom timeline, without hype. Let's get real. You're not watching this video to hear about someone making $5,000 a month from dividends in just 2 years. That's not what this channel is about. You want realistic, data-driven steps that give you more control over your money, and eventually, your time. So here's what this 2 ETF combo could look like over 10 to 20 years. Let's say you consistently invest $500 per month, split 70% into VUG and 30% into VYM. At historical average returns, your portfolio could grow to around $133,000 in 10 years, and over $400,000 in 20 years, assuming you reinvest all dividends and let the compounding run. Now let's zoom in on the income side. That 30% in VYM, if it grows to around $120,000 by year 20, and assuming a 3% yield, you could be pulling in roughly $3,600 per year in dividends. That's $300 per month, hypothetically. Not retirement level, but very real income that can ease the pressure of bills, part-time work, or just help you breathe. And more importantly, it's income that doesn't require you to sell shares or time the market. It just shows up. This is what I call your freedom timeline. It's not instant, it's not hype, but it builds confidence, and that confidence compounds alongside your dollars. Because one day, you'll have a month where your portfolio quietly pays you more than your boss ever gave you in a raise. And that moment changes everything. Is this actually better than VOO? Let's answer the question honestly. Yeah, in some periods, and for some goals, the VUG plus VYM combo has outperformed VOO. Over the last 10 years, a 70-30 split between VUG and VYM would have historically delivered a higher average return than VOO, with more dividend income along the way. But it's not about better in a vacuum, it's about alignment. What's better for you? If you want pure simplicity and you're okay with minimal income until much later, VOO is still a rock-solid core ETF. But if you want growth with optionality, income sooner, flexibility mid-journey, and a balanced mindset, then this 2 ETF setup is worth serious consideration. This isn't a bet against VOO. It's a system designed to do 2 things at once. Build long-term wealth through quality growth, while creating a cash flow floor you can actually use, and that's why I use it, because it matches my goals, real freedom, on a realistic timeline, without guessing games. And I want to hear from you in the comments. What's your current ETF split? Are you team VOO only? Or are you building your own VUG plus VYM barbell? Drop it below. I read every comment,